Meeting is being called to order. Can we have a roll call?
Councilmember Sayoc.
Here.
Councilmember Spector.
Here.
Councilmember Rennie.
Here.
Vice Mayor Jensen.
Here.
Mayor and Chair Leonardis.
Here. Will you please join me in the Pledge of Allegiance? I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. We're moving on to our consent calendar. I don't see anybody in the public audience yet. Does any member of council wish to pull an item from the consent calendar? Seeing none, can I have a motion? I'll make the motion. Move to approve consent calendar. Do I have a second?
Second.
All in favor? Aye.
Aye.
Opposed, none. Passes unanimously. Moving on to verbal communications. I do not see anybody from the public here this evening, so we'll move past that and move right on to our other business, items 4 and 5. And we'll have a staff report from Mr. Arne Andrews.
Honorable Mayor and Oversight Committee, thank you. The item before you now is an item that was heard at your Finance Committee, and it was a recommendation from staff based on conversations we've heard at the Finance Committee, at the Oversight Committee, and actually at Council Committee meetings to better define how and when monies deposited in the 115 Trust would be utilized. So that refinement you can see in a red line version of your investment policy, and the recommended language that came out of the Finance Committee was funds in the 115 Pension Trust may be used for long-term capital accumulation and appreciation, additional discretionary payments, or ADPs, and pension contribution management strategies. All of these have been discussed in one form or another, as I mentioned, either at council meetings, at an oversight committee meeting, or at your finance committee meetings. That concludes the presentation, and I'm available for any questions.
Thank you, Mr. Andrews. Questions for staff from council? Seeing none, we will move on to our public hearing, and I do not see anybody from the public here. So we will officially close the public hearing. We'll move back to council for discussion or motion. Councilmember Spector?
Try a motion. I'm going to move to adopt the recommendation of the Council Finance Committee to approve proposed revisions to the Town of Los Gatos IRS Section 115 Pension Trust and California Employers Retiree Benefit Trust Retirement Policy, Investment Policy.
We have a motion. Do we have a second? Vice Mayor?
Second.
Further comments? Seeing none, all in favor?
Aye.
Opposed, none. It passes unanimously. Moving on to item number 5.
Thank you, Mayor and Oversight Committee. This item before you was also heard at your Finance Committee on December 10th. It was a recommendation from staff to move the OPEB assets from the current CRBT Strategy 1 to CRBT Strategy 2. This item received a lot of discussion at the Finance Committee, and ultimately, both of your voting members opted not to make that recommendation to this council. During the course of their deliberations, there were a lot of comments to the fact that they didn't feel there was enough information. When things were discussed, staff wasn't prepared to present that information. And so the memo before you goes through some of the items that were discussed and tries to either clarify issues or prevent additional information. One of the main areas that I'll highlight to this body, because this body has a very different mandate than a finance committee, is oftentimes that the finance committee discussions focus solely on the concept of what's in the best interest of the town. And that's a very appropriate discussion to have at a finance committee, because the focus is on our community and our residents and what's the best value ultimately for them. However, when we transition to this body in the investment policy that we just discussed has a much larger fiduciary mandate, and therefore conversations have to be much more balanced in the way topics are discussed. And as you can see in the staff memo, right in the investment policy, you can see that balancing of language. You know, we have to be concerned about volatility of contributions, and that's one way of saying we need to be cognizant of our sponsor and make sure that we're not unwittingly doing anything that's going to be too detrimental to our sponsor. But then on the same hand, they talk about making sure that we protect the assets. We don't want to expose the assets to too much volatility. And at the end of the day, all of it is about protecting the benefits that have been guaranteed to current retirees and beneficiaries. One of the other areas that came up was a comment about, well, we're not even sure the savings we're going to get off the recent negotiations we just had with all our bargaining groups. So we need to keep a mindset of growing and accumulating these assets as fast or as long as we can. As you can see from the memo, some of the preliminary data does indicate that the savings will be significant over time, and in the next 10-year period, the anticipated savings is in the vicinity of about $3.4 million just for that partnership alone with our town employees. One of the other items that was discussed was if we move to a lower yielding, less volatile strategy, is it going to impair the funding status too much? Because we still have a plan that, even though it is a different plan now with the negotiations we just concluded, we do still need to grow the assets. And so one of the conversations was, can we really afford to go to a lower risk asset allocation, or is it going to be too much of an impact on the funding status? As the table before you illustrates, both the CRBT1 that we're currently in and the CRBT3, they actually track in a very similar manner. And with the 2018 investment earnings taken into account, they're going to track almost identical to what you would have thought coming out of your 2017 actuarial valuation. One of the other things we discussed was, a reduction in earnings. Can we really afford to go to a lower volatile, lower equity asset allocation? And all staff would caution is one of the reasons all these forward-looking, rates of return have been reducing is because after one of the most extended financial markets and economic expansions we've ever had, all of the folks that put together these assumptions keep lowering their assumption for equity because they just don't see a continued value proposition for equity in the long term. And so we would say that while the reduction is going to be, from about a 7.59 expected rate of return to a 7.01, we feel the reduction in the volatility in that asset class more than offsets the fact that it might have a lower earnings potential. One of the other areas of discussion is the notion that this plan will take 80 years, of making payments. I'm going to apologize now, but actuarial science often gets very morbid. One of the things we talk about in actuarial valuations is the concept of mortality. And so when you look at the 2017 actuarial valuation, they actually have tables that show the demographics of our active members and our retiree members. Looking at those tables, you can see that we currently have, combined between miscellaneous and the safety plan, about 148 active employees with an average age of 43.9. With our retirees, we have about 172 retirees with an average age of 69. Without trying to be, too insensitive, that population is not going to continue to receive benefits for an 80-year period. So our plan will transition in a relatively short period of time, and by relatively short, a couple decades, to almost only the active population. And with the partnership that we had with our bargaining groups, any new employee will not receive the benefit anyway. And so this is a plan that's going to move to a mature status much sooner than 80 years. One of the other items that got discussed was the concept of cash flow. The healthcare plan has a very different cash flow composite than the pension plan, and so cash flow is not an element that we're really concerned with the healthcare plan. That kind of concludes my summary of the memo, but I'm available for any questions.
Thank you, Mr. Andrews. Are there questions from council? Mr. Rennie.
Thank you. So one of the concerns I had at the Finance Committee that I'm not sure was completely answered, and it's maybe not really answered here, or if it is, maybe you need to explain it to me more. But when we're looking at reducing the risk in our portfolio, and my thinking is something's risky if you have to pull large sums of cash out at a point which you can't control. Because we know long-term risky investments make more money, but at any point in, say, the next 3 years, if we had to pull half of it out, we could be in a down market. But, you get 5 years and any down market's back up again pretty much. I'm not sure I got the numbers right, but my point is, if we don't think we're going to need unusual amounts at certain points, why do we need to reduce our risk?
And that is a very fair and a very good question. And in isolation, I would agree with you. If you have assets that can remain in perpetuity in an asset allocation, history has proven that equities outperform most other asset classes. What I would say, though, is one of the things that initiated this conversation for staff is that in the 2017 actuarial valuation that was just approved, this body adopted a lower discount rate. We went from a 7.25% discount rate to a 6.75% discount rate. And what that action does is it tells the actuary, let's do the net present value of our liabilities at a lower rate. And by doing it at a lower rate, that means we're going to recognize more of a reality of what we think the expected return needs to be to pay off those liabilities. And when you do make that reduction, it puts you in a position to not have to assume the greater risk that you would with a higher equity allocation and an asset allocation, because your liabilities are no longer being valued at that same risk profile. And so for staff, this conversation started because if your liabilities are being valued at one risk profile, why would you have the assets assume a higher risk at another risk profile? Oftentimes, in the pension world, those two tend to pretty closely parallel each other, maybe by a quarter of a point, maybe 30, 40 basis points. But the understanding is that you wouldn't unnecessarily expose the assets to a greater risk than what you're expecting your liabilities to be calculated at.
Mr. Rennie.
So if I could follow on, why wouldn't we just want to pay it off sooner? Why not, instead of adjusting our risk profile, adjust our assumptions that it's been calculated based on?
Fair point. In the last valuation, they did use a 20-year amortization, which is the ability to pay it off sooner. In addition, the town council has done a significant amount of pre-funding of the health care plan, which in the original staff memo that went to the finance committee, since 2009, you've pre-funded about $12 million in assets, and that $12 million in assets has earned about $4 million in investment returns for about an 8.3% average annualized return over a 10-year period.
If I could ask one more. So going to the other side of this, you put in the page 3 of the new report for tonight, you have a table of CRBT1 versus CRBT3, and you have 2019 CRBT1 at 58%. I assume that's percent funded. But in our report that went to the Finance Committee, 2018 was estimated at 61, so or 61.2, I think it was. So it looks funny. I know it's not the same year, so we're assuming it's going to drop in 2019. I'm just trying to calibrate this table a little bit to the other report.
And my apologies, there were a few dynamics happening in that report. One was staff went back to the actuaries and said, now that you know the 2018 data, if you were to recalculate things right now, what would the funding status be? And so if you did recalculate based on the 2018 investment returns, the current funded status in CRBT1 would be about 61%. When you approved your actuarial valuation in 2017, the CRBT1 funding status that you see in that table is what you knew at the time. And so I'm trying to get an apples-to-apples comparison, knowing that we do have 2018 investment returns. CRBT3, with those returns, if you were to move into that now based on what you knew when you accepted the 2017 valuation, this is how they would track. And then as the memo mentions, CRBT2 would start at roughly about a 58% funding level.
Okay, thank you.
Any more questions? Councilmember Spector.
Thank you, Mr. Mayor. Following up on issues that came up during the Finance Committee meeting, staff is recommending a reduced risk scenario, and that reduced risk scenario will have reduced returns. Mr. Andrews, can you quantify the increased risk in terms of reduced returns?
So it's a little crude, and thank you for the question, but the best that I can use is we talk about standard deviation when we talk about volatility of assets.
And I'm looking for numbers. Are you going to go there? I mean, because you have this greater risk, you're going to get this much less money. Do you have that kind of a metric?
I have not necessarily backed into the money, but it's basically the expected return difference of between 7.59% and 7.01. From a funding status perspective, we would say it's negligible, because they both track along a similar path heading into the 70s, the mid-70s. No, I don't have a dollar figure for you. Sorry, council member.
All right, and then, and this also came up during the Finance Committee meeting, if you make a certain assumption at a certain point in time, there are X number of employees currently employed, there are an X number of former employees, if you quantify that at a time certain, then how is this proposed change going to affect us?
So based on the 2017 actuarial valuation, we have roughly a little more than 50% of our employees in retiree status, and we have a little less than 50% of our employees in active status. Based on the average age of both those populations, our retiree population will probably be in a collecting status for another 20 to 30 years. The active population, possibly another 40 years. The new agreement that we have, that we partnered with all our bargaining units, is that no new hire is going to receive this similar benefit. And so that's why this plan will transition from an actuarial standpoint in a fairly quick manner. Most actuarial science, we just keep talking about the next 30 years and the next 30 years. This plan will probably transition fairly quickly, and I would say 10 to 20 years. I mean, the savings in the 10-year period are estimated to be about $3 million, but what's not captured in that number is the savings really start to accrue in the final years of the 10-year period. So the following 10-year period, you'll probably see something in the vicinity of double, maybe even more of that $3 million in savings.
And I can follow up because I'm not making my question clear. If we assume the employees that currently exist, and if we assume the retirees that currently exist, how much is owed or would be owed, and how will this change from the more risky to less risky impact that?
Thank you for the clarification, and I understand your question now. The unfunded liability associated with the health care plan with all the employees included was calculated at about $11 million. With the new earnings of 2018, the assumption is it would probably, if they recalculated everything, it would probably be in the vicinity of about $10 million. All the actuarial valuations show, as you see the increasing funding status, that translates into a lower unfunded status. So all of them show the unfunding status decreasing over time, provided all the other variables are met.
Anybody else have questions for staff? Seeing none, I don't see any members from the public, so we'll go ahead and we'll close the public hearing and we'll look to council for motion, comments. Councilmember Rennie?
Thank you. So again, going back to the table on page 3 of tonight's report, you're showing the difference between, let's say, out in 2027, the difference between CRBT1 and CRBT3 is only a 4% difference in funded status. And so 2 would be maybe 2 or 3% difference. And so I think the message you're sending, it's not worth the extra risk for only 2 or 3% more funded status. And maybe I could add another question on top of that. Does this include this assumption that we're putting $300,000 per year additional into this?
It does not, and you're correct. Staff's thesis is that with the reduction of the discount rate, what we view to be a fairly immaterial difference in the trajectory of funding status, we would not recommend having the higher risk associated with a 59% global equity allocation compared to a 40% one. And then, I'm sorry, the second part of your question?
I think you answered. The second part was, does this funding status assume this extra $300,000 per year that council has put in our policy?
And it does not, council member. All this assumes is what the actuaries calculate as the annual determined contribution. It does not take into account if this council goes above and beyond that annual determined contribution, or ADC.
Okay, thank you. And maybe I'll just close or finish with a little bit of a statement. I've been hesitant to change to a less risky just because, again, I don't see that we need the money in any big chunks at one time, so I don't think the risk is really there because you take a little bit out over time. So it makes more sense to me to go with the higher long-term earning potential fund. I realize you're only saying it's a few percent, but we're also only currently about a 60% funded. It seems too early to pull back. I know we're going on this benefit that we're able to eliminate new people coming into the pool, and it will stop growing as fast on us. But I've been hesitant to, like I said, I think it just feels like it's too early to pull back. I also don't like to do market timing, but with the market down quite a bit and continue to be down, by the time we get out, there may be more up potential in the future than we've been thinking for the risk. A lot of our, the actuarial, is actually the right word, the assumptions for our return are based on levels of where the market is. If the market was 30% lower, they would be telling you different assumptions on where the market's going to go in the future. So I kind of keep that in the back of my head a little bit. I don't want to jump out when the market is lower. That's not really the smart way to do it either. So those are my thoughts.
Councilmember Spector.
Thank you, Mr. Mayor. Starting with the way I would normally look at the issue that was before us at the Finance Committee and is again before us this evening, is if you say to me, we want to reduce the risk, my normal response would be absolutely. But in the Finance Committee meeting, and again with the additional information we've received this evening, I don't have that reaction. And I don't have that reaction in part because the risk has not been quantified or explained in such a way that I think there is a significant risk. So that's one. I don't think that the risk is that significant, especially within the parameters as Mr. Rennie has described them, and also as the way they were described by the financial people on our Finance Committee. The other thing is, I understand that we are not going to be having healthcare benefits for future employees, but still, by the time we finish our pool of employees, both employed and retired, it is going to be a significant amount of time. So again, based on my understanding and my opinions, and based upon Mr. Rennie said, which was all consistent with what the Finance Committee member said, which is why this comes forward as a unanimous or why the Finance Committee recommendation came forward unanimously. So I'm not going to be able to support the recommendation as proposed by staff.
Any other comments or a motion from council? Mr. Rennie.
I'll make the motion that we do not adopt the recommendation of staff and that we stay in the CRBT1 fund.
Do we have a second?
Second.
Further discussion from council? I'll call the question. All in favor?
Aye.
Opposed? None. It passes unanimously. And that was our last item, so we will adjourn this meeting.